It's not exactly barbarians at the gate, but mergers and acquisitions are on a tear. I'm Jack Hough, editor of BARRON'S.com. I'm here with Jack Hough, a senior editor at the magazine and the author of this week's cover story in which you look at this merger and acquisition boom.
Yeah, we're up 56% year to date on the dollar value of deals worldwide from last year.
And that dollar value, we're talking big numbers, $1.5 trillion,
right,
you report.
Might not hit an all-time high, but we could be on pace for the biggest year since 2007. And I think what's happened here, clearly, first of all, companies sit on a ton of cash. We know that. They've been buying back a lot of stock, but share repurchases become less of a good deal as stocks get more expensive, and the market's valuation is up. And I think when you look at what's going on with the stock performance, you've talked about this in the past, how companies that are making bids, their shares are actually outperforming on the announcement. That shows, and companies
it's
that
very unusual. Normally, the acquirer goes down and the acquiree goes up.
And companies that are buying back heaps of stock, their shares suddenly aren't doing that well. So that's investors kind of saying, you know what, maybe it's time for a little more, putting this cash to work through mergers if you can find good deals out there.
So you identified 10 companies that you think might be good candidates. And interestingly, you didn't go for the obvious ones because your feeling is, well, the bid is already baked into that share price. You tried to find some others.
Yeah, I mean, there's a trade-off. If you want to find the most obvious deals, like I think there could easily be a deal soon in managed care, for example. There are a lot of smaller companies out there and there are real advantages to scale in that business. But we've seen all of their stocks outperform. They've jumped even in the past month on that expectation. And if I'm an investor, I don't want to pay the takeover premium. I want to get the takeover premium. So we tried to look for some less obvious ones. We have, an advertising company, Interpublic group of company. There was recently a breakup of a big deal in advertising. Maybe someone will go after them. We've got some networks, Scripps Networks, and AMC out there.
Alaska Airlines, an old favorite of yours, right?
Alaska Airlines could be a pretty good fit between them and Delta. We'll have to see going forward. Kohl's might be a private equity target. They look cheap and pretty prosperous right now. So we look for companies with high free cash flow yields, low valuations based on enterprise value and EBITDA.
And basically these stocks are up more or less 1% today. That's the point of this exercise, to talk about stocks up in the magazine. Before we move on, I've got one question for you though. This worries me a little bit. You mentioned 2007, another big year for merger and acquisition was 2000. Is this froth? Is this the sign of a top?
It's cause for cautious optimism at this point. It could be eventually the sign of a peak in the market. What you want to look at is you want to make sure that the valuations on these deals don't get ridiculous. Right now the takeover premiums are actually a little bit below their long-term average, so we're okay there. And you want to be very wary of when you see deals with companies that just are a nonsensical fit. They don't really go together. And so far, we're seeing some more strategic deals.
Empire building.
Yeah.
Let's jump to two quick ones. Global Copper and Brass. This is a pick by David Englander.
Yeah.
And the stock jumped 5-6% last time I looked. Came
public earlier this year at $11, about 15 before the story, and David thinks it might be worth 25. It's a company that they're not quite at full capacity in terms of their manufacturing, so there's room for upside on the margins. It's closely tied with the housing recovery. We've had a little bit of a lull there, and the stock has come back a bit.
30%.
But if you're a believer in the long-term return to health in housing, then this is a good stock. The good thing about it is their manufacturing footprint is very hard to reproduce, and copper and brass, those are goods with clear, well-defined industrial demands, so you would expect as housing picks up, the stock could do well.
And importantly, he points out that when the price of copper goes up, this company has been able to pass that on to the customers. They shouldn't get hammered if the commodity goes up. Finally, this is a topic of probably more interest to journalists like us than regular folks, but Time Inc. is going public, and I didn't realize this until I read Andrew Barry's story. The stock's already out there trading, even though it hasn't officially happened yet.
Yeah, I like this idea a lot, and it's not because I think reading is going to be the next big thing, but whenever I see a split like this where one part of the company is supposed to be the darling and the other part of the company is supposed to be the dog, I get very interested in the dog because people tend to be extreme in their thinking as investors. They tend to put too high of a price on the attractive part of the business, too low of a price on the part of the business with some flaws. And I
think that's a great point. The market is replete with examples of that. CBS Viacom, CBS was the dog, it way outperformed.
So as Andrew points out, you get a very generous free cash flow yield here. I think it's something like a 10% free cash flow yield. and you get a pretty big dividend yield, 3.7%. So you're starting off with a really attractive valuation. You don't need things to go gangbusters to make money in the stock. If they just do better than the worst expectations of investors, you can do pretty well.
And of course, people have gotten killed in that stock. Ever since the AOL deal was made at that absurd valuation, it's just been a rough one.
Speaking of M&A market peaks, right?
We'll end on that. Thanks very much, Jack.
Thanks.